Hello accounts people, time to have a look at some partnership accounts. I've borrowed a question from BPP, perfectly good ones in the other publishers. We're going to go from a final trial balance through a profit or loss account, appropriation, adjust the current account and finish off the statement of financial position. Relatively straightforward question, there's no changes in the partnership, would affect the appropriation and current accounts. They're going to share the profits equally. One of them gets a salary and they all get the interest on their capital. So most of the figures are straight off the trial balance. You get little green arrows to click in the exam, make sure you do. But without further ado, there we are, there's the first one in, that's the figure from here. Also in, but now as a minus figure because we're taking it off. So sales minus cost of goods sold is our gross profit figure. So in this case we've got a single row for cost of goods sold, see that quite often in limited companies. Opening inventory plus purchases plus carriage inwards minus closing inventory. If you had that as separate figures, the numbers would go in this column and just the total across here. Watch also for this one, this first expense figure is in the second row here, so there's no figure in this row. All straight off the trial balance in this question. There can of course be adjustments. So type and then click them to make sure you haven't missed them off. If you've missed anything off, it will show at the end. And there is always the possibility that you will get a blank row to make you think. So all I need to do is add those off, put them as a minus figure. From advertising to irrecoverable debts. And then the profit for the year is the gross profit minus expenses. So that gives us, to be appropriated or profit for the year, 39,695. That's the figure that goes at the top of the appropriation account. Now that's not going to use this column, sometimes you will, but not on this one. So these are all minus figures. So remember, the salary is not a true salary, it's just the profits being appropriated before they're shared out. Only Emily gets a salary. Now this one we've got to work out. That's her capital. So capital of 25,000 times 5%. I'll put a minus symbol. It could go before the 25,000 because I want a minus figure. Could have done it this way around as well. Emily's capital is 15,000, so she gets less. And Karen only has 10,000 capital, so she gets less interest on the capital. Good example of why you give this out, because the partner with most money invested in the business gets a little bit more returns. And as they're already negative figures, we can work out the amount that we're going to distribute between the three of them as 33,195, the 39,695 minus the salary, interest on capitals. If we had interest on drawings, we would have added that in. Profit share then, so we just need to split it between the three of them. Well, that's quite simple, because equally divide by 3, 33 1/3%, but they're all going to get the same profit share, and hopefully it will add up back to the 33,195. That figure is the same. We can move on. So now we can move on to the capital account. We don't need the trial balance for that because we've just worked out all the figures. What we have got, we've got brought down figures. So these are the ones off the trial balance. They're all credit entries. Joe's, Emily's and Karen. only Emily gets the salary. We've got the interest on capital. This is what we've actually just worked out. And then the profit share. So that now adds up. So this is going to be the biggest side. They're all going to end up being credit balances at the end. So they're all going to be owed money by the partnership. But they've only just appropriated the profit, so that really should be the case. So we've got figures there. We know what the drawings are off the trial balance. Get the right number of zeros. That of course doesn't balance off yet, so the carrying down balance equals L 5 minus the 12,000. Could have done the cell reference there, and now it balances off, and it brings in, tells us that Joe has a credit balance of 13.15. Minus 16,355 minus 10,000. Just do it a different way, just to show the versions. Still works out the same, just balancing off an account. So account's left with 1795, and those are the balances that will go into the statement of financial position. So onto our statement of financial position then. Fairly traditional layout, variations on the theme from one to another, one question to another, particularly in the current assets and the current liabilities and the subtotals of current assets and assets. Just familiarise yourself with as many questions as possible, and of course the AAT ones. So off the trial balance we have the cost and the accumulated depreciation. The carrying amount is of course cost minus accumulated depreciation. Assuming you did advanced bookkeeping or ACPR first, you should know that. After trial balance, that's the cell reference. There we are, 5475. Put all the subtotals in. That's the one that matters. The 20175 is the value of our assets in our statement financial position. So this layout fits this question. Be prepared, don't get phased by an extra row or an extra or less columns. Maybe you've only got 2 columns for this section. It's just one person doing it differently to another. And that's a minus figure, but it says less, so we don't need to put the minus symbol in. So actually what we're showing is that the real value of the receivables is the sales ledger control account minus the allowance. I think I would have called that sales ledger control account and put receivables here, but so that is 50,000 minus 1,500. So notice this column for all the assets. Limited company prepayments would be added to receivables. It would be trade and other receivables, and bank of course can be negative. We've actually got an extra row here that we don't need, just to try and make you think. 74,700, that's the value of our current assets. And on this layout we need our current liabilities straight off the trial balance, no adjustment, because that is the adjustment, the accrual. In which case though the total still goes in the middle column, and it's not a negative. So 35,410, the value of our current liabilities. That's the value of our current assets, and our net current assets is our current assets minus our current liabilities. Working capital, some people call that. Quite a good name for it. It's the amount of money that you know you've got to play with in the business. And the net assets, so the book value of the business, is our non-current assets balance plus the net current assets. So 59,465 should balance with the capital and current accounts. You can see on the right I've actually done another version, another layout. We'll do that one in a minute. The capital accounts, unless there's been a change, will be the opening balances. Nearly missed a zero, I think. 50,000 capital, and on this layout, not absolutely critical. So these are the current accounts that we worked out after the profits. So if it was a sole trader, you see the profit plus the capital minus the drawings. Well, the drawings and the profits are in these figures, so they've already been done, so we only need the current accounts. Just the total of those, and the capital plus the current should equal the net assets. So that balance off with that. We should get exactly the same figures here, it's just a different way of laying it out. It's still might change the numbers. It's just a different way of laying it out, which is perfectly okay, and it'll all add up whichever way you do it to 59,465. So capital balance is the same as opening unless a change has happened. Current balance is the new ones after appropriation of profit or losses. Were they debit balances, so that they would just go down as a negative figure here, or you'd put a negative figure in here, and then it'll come to the right balance.